हेलो एवरीवन, मेरा नाम सिद्धार्थ है. This is the first video of my YouTube channel called Invest with Siddharth. I am an ex-IITian and I have also completed my MBA earlier from Indian School of Business, Hyderabad. I have worked with companies such as Kani, which is a globally renowned consulting firm. I have worked with Misho. I'm starting this channel as the objective of this channel is to help you provide strategy and tools to uh, do wealth management, to help you with investment in terms of mutual funds, stock markets, and other related securities. It is also to help you with better habits in terms of personal finance, with regards to just tax planning and all of that. So that's the objective of the channel. I think while we are trying to do all of that, there are certain few key principles that I'd like to follow with all of you. And if you like, of course, the content of this channel, please do hit the like on the video and subscribe to my channel. As I mentioned, there are a few ways that we'll follow on this channel, and the first will be that we'll try to have some fun. I, of course, while investing and money is serious business, I think life is not. So what we can do is, while we try to build our wealth collectively together, we can have fun at it. The second one is, I want this to be a crowdsourced content platform. What I mean by that is, while I do provide my own content in terms of what I believe is going to help you people, it will also be great for you to tell me what is the kind of content that you like. Like, for example, specifically, if there's a stock that you want an analysis on, or a mutual fund that you believe might help you, and you want a sort of an opinion on that, I think those are the things that I will be very happy to pick up if you ask those things for me in the comment section in other ways. That's the second one. The third part of this channel, which is very important, is that we grow together as a community. What I again mean by that is, uh, see, I have invested almost, and I have learned what I have learned in the last 15 years or so, across mutual funds, across stock market, etc. But I also believe that there's a lot that you guys know out there. You guys are also very sharp and intelligent people, and stock market is something which, with experience, there's a lot that you can learn. So collectively, I would want to learn from you, while I do want to help whatever I have and anything that I know in terms of mutual funds, stock markets, investing, wealth management, that can help you. I'd also want to learn from you. I'd also want to uh, grow as an individual further. So that's the third principle that will be helpful if you guys can collaborate with me as part of this channel. So having said that, I think let's delve right into the topic of today, which is just a basic primer of mutual funds for beginners. This will be a two-part series, just to clarify in the beginning. I think today what I'm going to cover is just a basic understanding of mutual funds, right? Uh, what I have seen out there is a lot of folks, um, while they understand in general terms what mutual funds is, etc., uh, at a overall level, like, the components of it, what are the ways mutual funds work, what are the advantages, how is it run, etc., etc., some of these things are not very very clear. So this first part I'm going to dedicate to particularly talk about just the basics of mutual funds. And in the second part, I'll be using some of the basics that I have talked here, and then go deeper into it, with examples that will help, like, even an intermediate level person who has done, let's say, investment in mutual funds, understand better how some of these principles work. And I think that will be very helpful. So please do keep an eye out for the second part of this video. So let's get started. Okay, so in this first part, there are four basic aspects about mutual funds that we'll cover. The first one is just what mutual funds are in general. The second part would be dedicated to what are advantages of investing in mutual funds. The third one is just operational aspects of mutual funds. How are they run on a daily basis, and what are some key components of it, key aspects of it. And the last one is what are some standard types of mutual funds? Now, today out there in the market, I think there are like hundreds of different kinds of mutual funds in every, I would say at a four basic division. There are like now hundreds of divisions of mutual funds. Of course, they're helpful now as investors. We have such a varied range of choices to actually do our investments. Is absolutely great, but of course also confuses people in terms of what this means, what that means. So we'll start with the basics, and slowly as we move forward, we'll figure out what each of the components in detail mean. So again, as I'm saying, like keep an eye out on some of the other series that is going to come after this. You can hit the button. I think you'll get automated messages on, and when there's those relevant videos do come up. So let's get started. I think first, what are mutual funds? So in basic terminology, mutual funds are investment vehicles. Okay, now that's also a very fancy word, investment vehicles. Just think of it as a type of investment which basically pulls money from a lot of investors and then puts into a diversified portfolio, right? What do I mean by a diversified portfolio? It's, in very basic terms, it means that instead of putting your money in one particular stock, like let's say ITC or HDFC, you are putting your money across multiple different stocks. Or it could also be that you're not only putting your money in multiple different stocks, but you're also investing it into a debt kind of schemes, right? Like government bonds, corporate bonds, etc., etc. So that's the difference. Like you are investing by design 100 rupees if you want to put, or 500 rupees you want to put into a diversified portfolio in a mutual fund directly, right? The second one is, like, in general, mutual funds are managed by, you know, asset management folks who have a lot of experience, right? So you as an investor can enjoy professional management of your money. Now, of course, there is a lot of pros and cons to that. There are a lot of debates around whether you actually get value out of active fund managers and whether passive fund managers are better, etc., etc. I think all of that is for a different video altogether. We'll cover it, but just to at a high level, like compared to a person who does not have a lot of knowledge in finance, compared to a person who does have a lot of knowledge in finance and has had at least a lot of experience in the stock market sector, we can trust the fact that that person will manage the money slightly better, right? So that's the only benefit. I won't put it in those simple terms. Now, moving on, right, as I said, what are the advantages of mutual funds? Now, the first advantage, which we already talked about in brief, is diversification. Now, what does diversification do? I mean, if I invest my money in one stock versus multiple stocks, how does it really matter? See, the best thing that it does is that it reduces the risk associated with your investments, right? Now, for example, and I'll cover this in more detail as I mentioned in my next video with more examples, detailed examples at a stock level, at a mutual fund level. So please be tuned in for that. But at a basic level, let's say you were wanting to invest in the banking sector, and you invested in HDFC Bank. That's what you thought is going to be best because it's a market leader in terms of market cap, in terms of growth, etc. But HDFC, as you know, at least in the past few months, has not been showing great returns, right? It has not performed at par compared to some of the other banks. So what it does is, while we believe that based on fundamentals, a certain stock is going to perform, and of course, in long term, those stocks are going to perform. Market depends on a lot of factors. That's the beauty of the markets. It's not just fundamentals, it's technicals, it's macros, it's sentiment, multiple things drive the markets. So because of that, what a mutual fund does it is, because it invests across multiple stocks, either in the same sector or within equity, across different industries, across different portfolios, it just helps to diversify the risk, right? So you're, on an average, your NAV will move up. Of course, it will also go down as the stock market goes down because it's tied into that. But the risk associated in terms of going down and going up is not as much compared to a single stock, right? That's the basic of it. The second thing I already mentioned, that experienced fund managers are the one who handle your investment, and hence you benefit from their knowledge, their experience of the stock market. They go very detailed in terms of fundamental and technical analysis to pick the stocks and to create value for you. Uh, we will have another deep and in-depth video which will cover on this in, I think, a few days, in terms of active fund management versus passive fund management, and what is good for you, what is not good for you. The third advantage of mutual fund is, of course, affordability. I think it just allows you as an investor to even invest very small amounts of money and get started with your investments, right? You don't have to have a lot of money to get started. Like if you have to buy a government bond, like that would be very expensive. Some of the government bonds are. But if you wanted to invest in a government bond with a mutual fund, I think you can do it with a small amount also. Um, the fourth one is flexibility. I think, as I had also mentioned, while there are different types of mutual funds, today the kind of flexibility mutual funds offer, like if I want to go and invest in a particular sector, like right now, defense as a sector is extremely attractive and has gotten a lot of traction because of just the investment philosophy that the government of India has been focusing on building in India in the defense sector. You look at Hindustan Aeronautics, there's a lot of funds in defense itself which have started recently. So all of these are very, very good advantages that you don't need to now go and do specific stock analysis and try and understand whether this stock is the one that is going to up. Defense is a thing that is going to absolutely do well. You can pick up a couple of mutual funds or one mutual fund in the defense theme, and you can just invest in that, and that is going to give you good returns in the longer term, right? So those are a few benefits and advantages of mutual funds. Liquidity is another advantage, but I wouldn't say it's a massive advantage. In fact, equity, just investing in stocks for that purpose, is more liquid compared to any other instrument. Of course, there are stocks which can perform poorly, but liquidity is not a very, very significant advantage. Now, we'll quickly move on to how do mutual funds work. As I said, they are managed by asset management companies. Some of the like top asset management companies right now is HDFC AMC. You can talk about SBI Mutual Fund, Axis, and Quant is also doing very well at the moment. So there are a lot of asset management companies who are in the mutual fund business. uh, I think every mutual fund, the second part of it, has a net asset value, which basically means it's the cost of buying one unit of that mutual fund on that particular day. The NAV varies day by day, right? It also depends on, of course, the kind of fund that you have, etc. But the NAV usually varies, and when you are investing at that point of time, you basically buy the units of the mutual fund at that particular net asset value. So if today you are investing in, let's say, Axis small cap fund, and the NAV of that fund is X rupees, then you will get one unit of that stock at X rupees, etc. Right? What does NAV really mean? It's basically the overall assets of the mutual funds minus its liabilities, and defined by the divided by the total number of units which are outstanding and have been sold to the investors. Uh, each mutual fund, I think, when they are constituted, they are formed, or at least established, with a certain investment objective or strategy. It's not that mutual funds are just created overnight and they are like, okay, let's invest money and we'll make a lot of money for the investors. That's not how it works. It's a very well regulated industry, with SEBI, MFI, etc., playing a key role in it. And hence, every fund manager and every AMC, for their mutual funds which they launch new or have they launched in the past, has need to have a very, very specific investment objective and strategy. Whether it's like, all right, I want to invest in a sector of infrastructure, and why do I want to invest in this sector of infrastructure? Because I want to build long term wealth by uh, establishing or at least extracting value out of the growth that India will see as a country when it comes to infrastructure. Right, so that becomes the objective of that fund. Of course, there will be multiple other objectives. I'm not going to go into the details of that, but that's just an example for you guys to understand. Mutual funds, of course, will charge an expense ratio to cover the operating costs. I think the fund managers, the salaries of the employees, etc., etc. There are a lot of factors. So there's an expense ratio that they charge to cover the cost of operating that fund. We'll have a separate video on expense ratio. I think it's a very debated topic out there. So I'll cover that in one of the upcoming videos. So expense ratio is something that you should look to analyze when you're buying or at least investing in a mutual fund. Mutual fund, of course, may also distribute dividends and capital gains to investor. It again depends on the type of the mutual fund. There are mutual funds which are growth, in which what happens is if you have invested in a dividend company, then what happens is those dividends directly go back into your investment itself. They are not coming back into your bank account. So if you invested 100 rupees in share A, and share A declared a dividend of let's say 5%, which means that at the end of the year you made 5 rupees. That 5 rupees, if you had invested in the stock, will come back to your bank account. But in a mutual fund which is growth oriented, what will happen is that those 5 rupees will again go back into your mutual fund only, and it will get bought at that particular NAV, even if it's like let's say a unit which is less than one that gets invested, it is going to go back into your fund only. We'll quickly cover the types of mutual funds also. As I had mentioned earlier in the part of my video, there are like hundreds of types of funds out there today, but we'll just cover the four basic ones, which are, I would say, legacy definition of mutual funds. And we'll do another video much more in detail about like what's equity, what's debt, what's hybrid funds, which will help you understand along with examples, etc. So first, let's go into equity funds. Equity funds is very simple. Equity funds are basically funds which primarily invest in stocks, right? I think there is a minimum limit for an equity fund. For example, for a large cap fund, I believe 85% of your investment should be into large cap stocks, and this is basically aiming for long term capital appreciation. So if you have a window of 5 years, 10 years for your investment, I think equity funds are fantastic in general. Within equity, of course, there are multiple different funds, and as I said, I'll cover a in depth equity mutual funds landscape uh, later on, and please do look forward to that video. Debt funds are the funds which invest in fixed income securities and offer regular income with lower risk. This also again has a varied range of securities. There is of course overnight fund in which your money matures overnight, of course within a day. Then there are liquid funds wherein your money can mature between 30 days to 90 days, etc. Hybrid funds, as the name suggests, it's a mix of equities and debt. Now, whether hybrid funds really add value, I think that's also a debated question. Some people believe yes, some people believe no. We will cover an analysis of this in upcoming videos. The fourth one is index funds. Index funds is one of the most talked about funds recently. I think it has gained traction in the past 5 years or so, when people have started to realize, like, what is the kind of benefit that you get from active investing versus passive investing. Index funds have gained a lot of traction, and there are a lot of uh, folks out there who strongly believe in the value of investing in index funds versus actively management funds, because index funds have low cost in terms of expense ratio, and they give you perhaps at par or better returns in general than some of the other funds. But again, this is a very, very widely open topic, and can have, I would say, a lot of debate. So nothing can be said with black and white kind of approach. It's not binary in nature. So yeah, in general, that was what I wanted to cover for today's video, folks. Please do look forward to the second part of this. As I said, I will go into detail in some of these aspects, like for example, how does diversification help in one particular mutual fund, along with an example. So yeah, that's about it. Thank you for joining me today. If you did like the content, please do subscribe, and please do share if you believe that this video is going to help someone in your circle. Thank you so much. Jai Hind.